Welcome to the Acquisition Collective podcast. I am your host, Charlie Tanner. Thank you for tuning in. This is the place where we discuss all things around the M&A landscape. So if that sounds like it's up your street, then stay tuned and let's dive into this week's guest. So on this week's episode of the Acquisition Collective podcast, we have Sean Highland down to join us.
And Charlie.
Shaun has the experience of the commercial lending world within the M&A landscape. So if you can, Shaun, introduce yourself and tell us all about yourself.
The experience is quite a nice way of saying isn't it? The more mature advisor.
I like to say seasoned, but that's my go-to.
I qualified as a chartered accountant 36 years ago, and pretty much I spent a little bit of time out in industry, both in a PLC environment and in a turnaround engineering business, a small group. But most of the time I've been structuring and restructuring debt. Dabble occasionally with investment, but it's not really my space. But the SME lending market, I've been around for, like I say, most of the last sort of 40 years.
Yeah.
And a few changes here and there. And some of the time actually in lending organizations as well, so working in new business for lenders. Yeah, so it's a strange place because once you've been in a few lenders, you build a network of people who at one stage are colleagues, they go off to another lender, you go into advisory. And so if you've got those connections, direct phone calls into various lenders around the market where you get sometimes a bit more sharp and honest answer.
Yeah.
Which is what I think everybody's looking for at the moment. Everyone wants a bit of clarity about things.
Because obviously current to date, we're recording in April. So are you seeing the market as being a bit restrictive with everything that's going on, or is it quite open and ready to go?
That's a really interesting question. There's I think people are nervous at the moment.
Yeah.
So you look at the markets that are the bits of the market, the lending market, it's always quite a broad brush, but there's bits of it that are experiencing some real issues. And the one at the moment that seems to be quite current is the bridging loan market in property.
Yeah, so you do a fair bit in property as well.
Yeah,
as well as business.
There was a phenomenal statistic I saw a couple of weeks ago, which was the total bridging market in the UK is just shy of 14 billion, and 20% of it is held by lenders that are currently in administration.
Oh, really? Wow.
So it's so there's a lot of, and I think with property it's an interesting one anyway, because you've got that question mark over, is a residential portfolio the place to be because it's been regulated out of existence? Is the commercial space the place to be because who are you going to put in as tenants?
I have both, and I don't actively add into either.
Yeah, okay. Well, there you go. And then the sort of, I think lenders in general though are just nervous. You just need to have a better business case.
Yeah.
And sometimes that's about the structure and security you offer. Sometimes it's about the actual basic business proposition. But always there's an element of it. Is this guy legit? Is he actually a person I feel that I can trust to get my money back?
Yeah. No, I get that. And that's the thing with property. It's the spreadsheet says one thing, in reality is always a different thing, because spreadsheet looks nice and good to go. But in reality, when you start instructing builders and all sorts, the timeline always gets not so much stretched, but if you don't have experience, which a lot of the resi buy-to-let people or renovation people don't really, then they get caught out. I was quite lucky. I come from tier 1 project management for house builders before I ventured off into property development. So I had that. I could always structure a program for builders to work to, which obviously come off the back of leveraging a lend, obviously was coinciding with one another. So I was okay on that front, but the majority of people in property development don't have that advantage.
But I think, because I don't, property's a bit of what I do. Probably most of the clients I'm working with at the moment are in the M&A space. You've got a few that are just sort of simple refinances. But I think all of it, to some extent, there's that project management element to it.
Yeah.
And I think you can almost look at a typical sort of property land, particularly say it's a development or a refurb, and almost use the principles you use when you're trying to put that together to the acquisition of precision engineering business. Because there'll be bits you can control, and then the bits that are totally out of your control.
Yeah.
And how do you try and insulate the financial stability of the business from the bits that you genuinely can't control? You just got to cling on for.
Yeah, I think a lot of transferable skills come from people and property to M&A. I was one of them, for example. Like, what brought M&A into my life was obviously the free guru YouTube videos. Obviously, I started with property ones and then kept popping up this whole M&A thing, and that was like 10 years ago. So that's what pulled me into M&A, because it then sort of opened my eyes, and I started reading, talking to other professionals in the space, and then that's how I transferred over. And then I was just lucky enough to be working for a business owner who wanted to exit. So then I said, I'll acquire you, but I've got no money, and I'll do it on obviously a profit share over 3 years. And he wanted to retire so badly, he went, yeah. And I was like, oh, okay, cool. And so then that's like, I was very lucky to get into my first ever acquisition like that. Whereas other people, like, they search a long time and they don't quite understand it because they're too nervous to make that first jump. Once they get on it, once they get it going, they can then kick on sort of thing. But I think finding your first acquisition is quite difficult.
And I think you to me, you've touched on a really interesting point, which is understanding what the motivation, understanding what the seller is actually planning to do. Yeah. Because that makes a world of difference as to what you can do in terms of the structure that's going to be acceptable. Yeah. And it's the worst ones are sometimes, I've worked on so many like management buyouts where it's introduced to you normally by the company accountant, who somehow is advising both sides.
Yeah.
And it always starts, so it's all very friendly, it's all very amicable. We're doing this, and you just
until due diligence.
Just stop a second, because at some point in this process, you're going to sit either side of a table with a big pile of cash in the middle.
Yeah.
And every fiver goes one way or the other. And that's when suddenly the gloves will come off at some point. So just stay coldly professional all the way through it.
Yeah, that's a good shout. It's like my two, because I've had 2 exits, right? And obviously I've only ever acquired in construction for all my sins. And both of mine have been internal buyouts because the businesses didn't suit and couldn't handle an external acquisition because they couldn't. I knew that they wouldn't be able to repay the debt because the business model of like a main contractor can't, because cash flow is always non-existent anyway, or very tight. Even when I built a 2-year run rate for that business, it was still choppy, because you always want to start a new project to grow or something like that. And it's always very material. You have to pay for materials up front at your own part and whatnot. Yes, you can get payment terms from a merchant and then maybe extend it with like a big credit card, but that only goes so far before you got to outlay like a few $100,000, to get going. And then cash flow is always tight. So that sort of business model doesn't suit a standard transaction.
No.
Hence the reason middle management bought me out, and I said, you're not going to pay me down day one. I'm going to double the multiple and you're going to pay me over 10 years.
And that's another really interesting from a lender's perspective, because their perspective is an interesting one, because when you're buying, you're always looking at it as essentially an investor. You're buying, and everything that is exciting you about that opportunity is how high that business is going to fly. Everything you're all about, how can I increase sales? How can I increase the profit? How can I get to treble the value of this business in 5 years, and then maybe think about a sale or maybe an add-on? And a lender isn't like that. So
they lend on today's.
Yeah, but a lender will get his money back, hopefully, and he'll get his interest. If your business is suddenly worth 5 times as much, he gets his money back, he gets his interest.
And that's why I find, that's why I don't get commercial lend. That's why I've never gone to market to get lending. One, because on paper, the acquisitions I make don't make sense in terms of a lend, because I know what I can do with a business. Because if I was to lend, I would just leverage the debt book sort of thing, or the assets, just to get the down payment going, because I know how to grow a business in that industry within 2 years.
Yeah.
Or I take the risk on doing that with a view that if it doesn't go to plan, me personally, I've got other things how I can plug that. So my risk is instantly higher than the lend, right? So not to say that there will be a day where I'll have to get lending with bigger businesses I'll look to buy in the future, of course. But for the businesses I've acquired and bolted together, I haven't needed to. Yeah. I've had my own cash pot. So,
but
that's my own model of not. It doesn't make sense. But where in the future I want to pivot into like manufacturing engineering, that's going to take a different approach, and lending, of course.
And that's the thing is with a lender, like I say, is if your business is really successful, he gets his money back, he gets his interest. It's still the same percent. So his focus is not on upside. It's just down what happens if this doesn't work.
Yeah. It's covering risk.
Yeah.
At the end of
and
the
so that's why you tend to find there's that sort of element of want a big capital contribution. So if you're going down that 5-year term loan route, they're always saying, but typically sort of 20% or so. I know on some of the smaller transactions, the clear as a loss, but half of the consideration to come in from the purchaser. And that's why I sort of always start every opportunity. You start with a blank sheet of paper. Like, what are the options? What could you do? And like those ABL type solutions, like they're great because that security, those assets, is what's giving the lender their exit. So they're less inclined to come looking to you for big capital contributions and personal guarantees.
Yeah, well, I see asset-based lending is like literally leverage assets or debtor books or whatnot. So they can be normally turned around in a quick amount of time, can't they?
Yeah.
So within 30 days.
Yeah. So you can do. I've done an acquisition of a fire door manufacturer, and they had an internal partitioning business, so almost touching on construction.
Yeah, nice.
A lot of it was contractual debt as well.
Yeah,
and that was we were working for a PE house, which makes it slightly different. But the principals on the deal were in Australia at the time. Business was coming out of an administration.
Okay.
So a lot of things there for a lender to try and get their head around. Plus the KYC and AML was a little bit difficult because obviously they had all their documents with them. And we turned that around in 7 days.
That's good.
And that was really good old Bibby, actually.
Yeah, Bibby, lovely. Yeah, so Bibby's a go-to construction lender.
Yeah. So you can do them that quickly. The thing that slows it is the nature of the asset. So if you're looking at leveraging, say, plant and machinery, if it's pretty standard sort of CNC machines, sometimes they'll go on a desktop, but normally they'll want some form of valuation. It's getting the valuation, it's getting those third parties involved in the deal that pushes it out. So your typical timeline for an asset-based lend, you tend to talk about 4 to 6 weeks. Whereas if you're looking at a 5-year acquisition term loan, you don't see them get completed in much under 3 months ever. And that's on the basis that everything goes well.
Yeah, because that's what I say to people. I say to think, if you're getting it within 8 to 12, you're doing good, but you can go up to 20. Weeks,
and some.
And that's why, like, people that I talk to who are like actively searching, it's like you might be searching and sending out indicative offers, but you need to understand your lend, because if you want to get a traditional acquisition loan, you need to come with, was it up to 25% down yourself?
Typically sort of 20% or so, and then with the cheaper end of the market, if you go into the clearing banks, I haven't seen them do much more than 50% of business purchase.
Yeah, so, which makes sense, really, just to cover their risk. And then also, you got to get that modelled out correctly, because people, I will bang this drum until I will bang it forever. Like, the financial modeller is essential both pre and post acquisition.
Yeah.
If you don't understand lending or financial forecasting, then you need to talk with a financial modeller to help you with your acquisition buy box and then your post-acquisition payback as well. That will do you a dream, and they will design you a nice funky template or whatnot to go with it, so you can punch in numbers and see if deals are right for you, and then you can get them off your desk. But it's a great investment to sit down with a financial modeller for
and rates as well, because everyone is, like I say, in a market where people are uncertain, that means there's more risk. Banks, you're probably looking at on those 5-year term loans, probably around about 8-9% would be a good rate to get.
You're in double figures at the minute.
Non-bank, you're looking more like 12 to 15.
Yeah.
And then you have this added problem where it's the smaller deals are the ones that are quite difficult. So
just for the audience, banks don't like to lend under $1 million. They don't intend to get.
No, especially so. What I'm finding, this is really strange because my answer maybe 12 months ago would have been slightly different. So I've got a small acquisition on the go at the moment with HSBC, and the total on that is probably going to be 225,000. But that's split between they're doing half of the purchase price of the business and 75% LTV on the property the business operates from.
Yeah, so I know some people's model when they go to acquire is they buy the freehold and they leverage that to buy the business, which sounds similar to that.
The only challenge is that normally on a commercial property, you're lucky to get much more than 70% LTV. So that immediately introduces a 30% deposit.
Yeah.
So that's got to come from somewhere. And so actually, I sort of quite like, try and get a 5-year lease with an option to buy. And if you can agree the purchase price, the strike price. So you take, say, a 5-year lease and you could say you've only got the option to buy, you can exercise from year 3 to year 5 or just at the end of year 5. Yeah. And that just takes that cash. You've got the security of tenure, but you've taken that cash out of the way.
That's my actual go-to approach for acquiring. Obviously, if it's got a freehold building in it, obviously, I always want the building, but I don't want to pay for the building on day one. I want the business. That's what I really want. But 9 times out of 10, that building is either built or bought for that business, so it needs it. So my go-to offer is I offer for the business and I 36-month option agreement for the building. Because I know that within 2 years I can grow the business or try, and then I can leverage it again to buy the building. Yeah. That's my go-to plan, Or worst case, I can leverage my portfolio to buy the building if it's good enough, but it's always at market rate, so I never want it. Or I just bring someone else in that I know who adds to their commercial portfolio, and I get a 10-year leasehold or what.
And there's a little.
So there's all these other things that I can do.
There's a little slew of businesses coming onto the market, sort of 12, 18 months ago, and you look at them, and the business have been marketed for 12 or 18 months prior to that as well. And actually what it was the lender, the seller was actually trying to sell a property. Yeah. But there were no buyers for the property. Yeah. His business is a tenant. So hit on the bright idea that actually let's just sell the business. And you actually had sort of a property investors looked at it, didn't like the tenant. So that tells you everything you need to know about the quality of the business. And they also didn't really like the property. So by bringing two things that are unattractive added together doesn't necessarily make it attractive.
No, I've had a few come across my desk that I've been in negotiation with, and they're like, it needs to be bought. I was like, I don't want to buy it. Yeah, but the business owns it. I was like, why is it structured like that? It's not even structured separately.
Yeah.
It's like, well, can't you just keep it? But obviously the cost to take it out of the business, it doesn't make sense. So that's why business is on market for so long, because you have to buy both.
Yeah.
And no one wants both. 9 times out of 10.
Yeah, it's so going back to your original question, so actually at the moment the banks, probably not Lloyd's, probably not Barclays, but RBS and occasionally Metro, but they're a little bit difficult. They normally do like to see a property in there.
Okay.
Working on something at the moment which is a little bit quirky, and that's with an odd bank lender, Triodos, who are sort of positive cultural, environmental and social impact.
Very different,
lenders.
Aren't they?
Yeah. So they're in the market, and certainly HSBC, RBS will look at sub £1 million. Outside of them, there's very few people in that sub £1 million market.
Yeah.
Just because the view of the lender is those businesses are typically sort of single products or reliant on a major customer, and that makes them higher risk. And also they just don't have the critical mass to weather a bit of a storm. So there are a couple of non-bank lenders out there, but they are really expensive. So we're talking 15%.
I was going to say, so what's the difference between sub $1 million, sort of 15% or more, is it? Is it high rates, basically?
It's higher rates, or that sort of, you need to contribute a significant amount. Then you've got a couple of lenders come into the market at about $1 million. And then really it sort of starts going at 2 million of debt.
Yeah.
But at that 2 million of debt, your purchaser is probably going to be looking at having to stump up
$500,000,
300, 400, 500,000. So it's not an easy one, and that's why that sort of structure. I think is the biggest challenge is for first time buyers. So also within that, I've had a kickback from a couple of lenders on an opportunity in the last month, literally. But they're just saying, because of the nature of how this is being structured, the acquiring business has got no track record, therefore that's a management buy-in, and that takes it outside of our policy. So MBIs, the lenders tend to not like,
and that's very popular at the minute, MBIs, because it's a realistic strategy in acquiring your first business.
Yeah, exactly.
So especially for like serial operators who've gone to start a search fund or alternative PE guys, that's their go-to strategy.
Yeah.
So
MBIs are quite challenging, just because lenders, you've got the classic example is the people you speak to or I speak to, they say, can you just run the rule over this one? Have a look. What could I borrow? What's the debt capacity of the target? Because I'm looking to do it on a leverage basis. Yeah, okay, what does the business do? And it's a care home. And then that doesn't really progress. And they say, well, looking at this business now, what does it do? Oh, it's an insurance broker. And then they come back to you a couple of weeks later and say, I'm looking at this precision engineering. Oh, well, hang on. I'm not certain that you've actually got the wherewithal to run all these businesses.
You don't know,
And so I think that in itself, that is why the lenders are slightly nervous of that. MBI is like, do you actually know?
But that comes from this whole thing of sector agnostic, which I absolutely hate. If you're going to acquire a business, you need to have it now down to no more than 3 industries, I'd say. And similar industries like that, like the minute you hear someone going 3 totally different sectors, industries, business models, it's a bit like, oh, are you serious? Do you know what you're doing? Of course, people can do that. Don't get me wrong. But for their first, you're thinking you need to be saying, bring me, if you're saying, yeah, I've got these 4 different engineering companies, what do you think? You think, okay, cool. So he's definitely in this hole. It makes sense, especially if he comes from operating, like overseeing engineering companies for the last 2 decades. That makes total sense. You know?
Or it's one of those businesses that is is just really simple. There are some businesses that are not complicated, but and the thing is, what you have is the normal pushback, and you completely get it, is the purchaser says, oh yeah, but there's a really strong second tier management team. Okay, that's great. And then I know what the lender will then say, which is the first question the lender will ask. But the first question the lender asks is, right, why are they not buying the business?
Yeah, that's more so. When dealing with on-market brokers, right, and they occasionally come to me and say, Charlie, we've got this opportunity, do you want to look at it? That's one of my first 5 questions. You've got middle management in place. Why don't they want it? They can do what I do and leverage the business to pay it out, or it'll be even easier to sell it to them. Oh, no, they don't want it. All right. So if they don't want it, they sound like a really good middle management team that I want to inherit.
It's and those you see the horror stories, things like EOT, sales into EOT, because you're relying, particularly where they're structured with a significant amount of deferred, and then you get the 2 or 3 principals who are in the employee team who you sort of leave. It's
nothing holding there,
and there is there's a lot of reasons why a lot of people who are really strong second tier management don't want to be a business owner. Not everyone wants.
It's a massive transition in itself, and
massive pay cut.
Yeah, it's not for the faint-hearted. People think, oh yeah, you own a business, you're going to earn hundreds of thousands. Initially, you don't. Like I know a fair amount of business owners who turn over a few £1 million businesses, etc. Like their middle management are earning more than them. Like, all right, maybe if they have a good year, they might get topped up over them with a few dividends, but then they get taxed to the high heavens. Like it surprised me when I started looking and having discovery calls with potential sellers like years ago. how many business owners don't earn more than 100 grand?
Yeah.
You know?
Oh yeah, absolutely.
And then they're still day to day. It's like you just developed this big job for yourself with all the pressure, added pressure. And that's why some people don't want that. And it takes a certain type of person, a really persistent, hard-working person, to run a business. Like, it's not for the faint-hearted.
I'd love to know. I don't know the statistic, but I would love to know how many, particularly first-time acquirers, but people buying SME businesses in the first 12 months don't earn the minimum wage for the hours that they actually work.
I think all of them, because your first acquisition that you do, you work hard. Literally, you don't know what to do. You don't want it to fail. You work all hours given just to burn yourself out. You will do that. You have to go through that, I think.
And you do, because you're spending loads of time just finding out who in the team is with you and who is almost working against you.
I think even with my first acquisition, I was very lucky. I inherited a contracts manager and a very good build team, right? So I didn't have to worry about back end, lucky enough. So, and then the business never done sales, marketing. So I was just left to go and network with architects, because in that industry, that's who the gatekeepers were. So I just went and attacked them and built rapport with them. Obviously, architects are a bit like accountants. Some can be very strange and odd and funky, and they're slow burns to get in with. And it worked out over time. But yeah, you do, looking back now, daily hours is, you're there for everyone at night. You're there working on the business, neglecting your wife and kids, which I was. And yeah, you either get a wife like mine who says you need to stop this after a few years and say you need to chill out, or it's going to go left, or you get a lot of business owners who go through that for years and years and years, and they get to the end of the tree or the end of the tunnel where they have a good, successful business, but they got no real happy life around them because they've all left them because they've neglected them.
Or the ones that are really sad is the ones where they have got through that, they've got to the successful bit, but they are absolutely integral to that business.
Yeah.
And so
I see it a lot.
the business isn't worth anything.
Because with my brokerage, I specialise with construction, manufacturing, engineering, business owners predominantly, because that's my experience, my bag, right? And a lot of them, a lot of them come from the tools, get into a business. 2 decades later, they got big businesses somehow. They just evolved and compounded into what they are. And yeah, they don't leave. Like, I know a lot of them that get there at 8 in the morning, leave at 8 at night, and it's like, what you do? You actually, like, I know owners who have middle management in place that they're just there because it's like their routine. And it's like, well, what are you doing? It's like, well, would you like to be here? I'd like to oversee it. But if we took you out, would that middle management actually act like a middle management? Because just you sitting in your office day in, day out, that still gives them a comfort blanket to refer to you for, which you can say all you want, mate. Doesn't happen. In reality, it will happen.
And it's an odd one when you're the buyer to think that what you're trying to buy is something that over the years you are not needed to be. You literally want something that does not need you to be involved in it.
Yeah. And to set a business up to be fully functioning without you isn't actually that hard. It's just letting go and trusting it, and trusting a report sheet, or trusting whoever's overseeing that, whoever's telling you about, obviously, the day-to-day, you can actually trust.
Yeah.
I mean, my second exit, I wasn't day-to-day. I'm not day-to-day in any of my businesses, so apart from one. But my electrical businesses that I grouped together, it's all good, because my model is I bring whoever's day-to-day operates a business, I give them a profit share of 25%, and then that, after X amount of time, will equate to shares, and we share the pie, right?
Yeah.
3 years in, heard on the grapevine, doesn't like my approach, thinks I'm lazy, all this other stuff, blah, blah, blah. So in my opinion, greed got in his ear and head, and basically he wanted the pie. That's fine. If you got that attitude at this stage and you're not looking at the bigger picture, then we're not aligned, and we're not the right fit. So there's 2 options there. You go, or you buy me out. He goes, because what started off, he made a comment once saying, yeah, well, I'm going to buy you out eventually anyway. I was like, oh, right. Okay. Didn't know that. I thought it was my name on the door sort of thing, because I was enjoying shareholder. And he's like, no. I said, I'll tell you what, you put me an offer forward and then you can buy me out again. Nothing, you don't have to pay me down day one. You can pay me over 10 years. Because where I'm at in my life, I've got 10 years to look after my kids while they want me, while I'm cool, before they hit their teens. And then I'm allowed to go buying and building. That's what I'm allowed by the wife. So I thought, I'll just send another one in then. If we're not aligned and he's not on the same page, then I'll let that go as well. That's no problem. Gone. That took 6 weeks. Lawyer, thank you. Can you draw this paperwork up? Put it in front of him. He goes, he's happy with them terms. Cool, thanks. And if he fails to pay me one payment, then I'll get it back. It's on that sort of generic setup. So that's how my 2 exits have happened. Well, my first exit happened because I was just doing too much. I was doing that. I had second born on the way. I was doing developments. I was trying to wangle a 9 to 5 to pay for my household while everything paid for itself, and put like cash flow in everything. So I was spinning a lot of hats and dodging a lot of people, and I was burning myself out. So you can imagine what the wife was like. She was like, why are you doing that? You just need to relax a bit. Like, the foundations here, we're set. You need to get rid of some stuff. Yeah. So I said, okay, I'll stop developing. She said, sell the business as well, because at that point I had like 3. And she's like, yeah, sell the business. So I offloaded that within 6 months. And then all of a sudden, I thought I was retired, but I couldn't retire. I had the summer off, and then I had to go do something. So my consulting business evolved into my brokerage.
Wait until you get to my age.
Yeah. So, but no, it's been good fun. I mean, acquiring businesses is very good, but it's not for the faint-hearted. So all of these people aspiring, I will always say that everything that's online that makes it look really sexy and really easy, to a certain degree, if you're a certain type of person, it can be it is sexy and it is rewarding. Don't get me wrong. It's very hard. It's very strategic, and it's not overnight. Don't get me wrong. They make out all these online gurus and people pumping the space. They're like, yeah, overnight, you acquire your business overnight. The business pays for itself. You get yourself a salary and blah, blah, blah. Yeah, all right, that can be an option, but you still have to put the hard work in. You still have to restructure businesses. You still have to understand businesses yourself before. And if you come from an employment background or an employee to a business owner, your mindset shift is a lot. My first business took me 18 months really to stabilize and fully understand it. My second business, probably 6 months, because that was in slightly different sector, although still in construction. So you're forever evolving and learning, which is good if you're up for that. But if your mindset's very rigid and one-dimensional, you won't suit the acquisition space.
And you've got to. It's like on the financial side when you're looking at sort of things like forecasts. It's all about. I'm like you. I wouldn't. I can't really understand why someone wouldn't want to run a business with a forecast. But so many people I've met say, yeah, but it's impossible.
I know companies between 5 and 10 million that don't forecast.
Yeah.
It baffles me, mate. Seriously, it is one thing. Like, if you've got no line to follow or projected line to follow for the financial year ahead, but then also they're them businesses that don't financially report properly. They have external accountants who tell them how much profit they get at the end of the year.
Yeah.
So they have no vision on their business. Like, a lot of them businesses are always running close to insolvency without realising it. The business owner, they tend to be the ones that go, oh yeah, but we've got X amount of cash in the bank, we're all right. And it's like, what's your break-even point? What do you need to stay afloat? I don't know, about 40 grand. So you got 20 grand in your account. Yeah, good.
Cool. Yeah, and it's this kind of, with a forecast, you sort of, the PLC that I worked in, we used to have, it was a bit more detailed, but it used to have the original plan for the year, and then you would have on a quarterly basis budget. Yeah. So you got the plan, then you have budget. The budget was the plan flexed for the things that are completely outside of your control. So interest rates, tariffs, if Donald is so minded, that sort of thing.
Yeah.
And you would adjust what you needed to in the plan to reflect what the budget then is.
Yeah.
And then each month you'd update a forecast.
Correct.
The forecast was what was actually going on. And
you need to have
what you
tracks,
do is the forecast becomes this tool by which, okay, so we're not on the original plan, we've tailed off of that, but you need to make a decision as to either what you need to do to get back on plan, or actually, is the path you're going down better than the original plan?
The thing, like you said, businesses that don't forecast and track it monthly, like you said, you can't see where you're currently at. So there's no point having an accounts department because they're just a data entry. They're just reporting into something that happened however long ago. Obsolete. But if you can't see where you're at, you can't pivot. And if you can't see where you're at, you can't see if you're declining, flatlining, or dead. So you need to be able to react as quick as possible to know what you're doing and where you're going. Or you need to say, this isn't working. And then it leads into other things. Obviously, like you said, budget, whip, stock, like things of that nature that make your business operate, depending on what it is.
Yeah.
Or whether you need to employ other people or unfortunately get rid of some, for X amount of time, or whether you need to bring on a subcontractor to fill a void, or whether you need to go and employ in 6 months' time. You can look forward for that. So proper financial reporting and forecasting, I see it as a basic in your commercial.
And I think,
but it doesn't happen a lot.
And I think purchasers need to get their heads around that, because the nature, the mindset of a lender is that they will expect that because they don't want any risk. They want to know what's going to happen. They want to know what the path is. And to some extent, raising money is just a game. It's a little game, but you don't dictate the rules.
No.
Because the guy on the other end of the conversation, the lender, is the person who's actually got the money that you want.
Yeah.
So play his game by his rules for a little while.
Yeah, and it's all about, I'll say this to anyone, just understand, like you said, that person, just go and talk to a few of them people and understand what they want data-wise from a business so you don't waste their time. So as long as you understand the structure of that, what they require to see eyes on, then produce that. And then they can just go, I'll come back to you within a week and tell you what you can get, and then if it's a goer, then you need to know if that business can serve the debt, like your debt cover ratio and all that, because
it's like you go into them asking for a loan and they say, can you give us an analysis of your top 10 customers, turnover, and you go back and say, here's the range of colours that we do them in.
Here's the pie chart.
That's not what he asked. Just give the guy. But I'm not saying that he's going to run your business. I'm not saying that you need to do this ever again. But for those 6 weeks or 12 weeks, play the game by his rules.
Shows that you understand financially and commercially what this business can handle and what it has been going through today. So any business you're looking to acquire, you should understand its customer, and client base. And like you said, break it down to the top 10 and then go again and then find out what them businesses turn over themselves to see whether you're at risk of losing that client.
Yeah.
Because that's another thing. When you make an acquisition and the name on the door changes, materials, clients, potential future tenders, they all shit their pants, but in simple terms, and some of them pull back, like account credit limits and obviously payment terms, so it's all things like that.
And the classic is, it's really good, really strong, like we said before, second tier team, maybe the one below that as well, absolute engine room of your business. And so those people, when you say, look, they've been there 20 years, this one's been there 15 years, this one's been 25 years, you've just explained to yourself that those people don't like change. So they're going to be really unsettled, they're really jittery. And so the one thing you can't, again, from the finance point of view, one thing you cannot afford to do is just about squeak the deal over the line, but have nothing left for
Yeah.
for next. Because if their payroll is a day late, the first month you're in control, boy, you're going to have a real problem on your hands.
That's why when I've looked at my lending criteria, right, because I build everything out, sort of thing. So I know obviously the parameters of lending and whatnot, and I've applied it to my buy box or whatever term I want to call it. Sorry, I will never leverage more than 50% of a business. Personally, that's just my go-to, because if I know post-acquisition, a business will always dip within the first 6 to 9 months, probably 30%. So if it's dipping 30%, I don't want to go over 50%. So I know that I've got a bit of wiggle room if required. I don't want to be caught short.
Especially the ones where people use the debtor book.
Yeah.
Because
and that's the go-to.
Yeah.
And that's the reason I'm not a great fan of some of the go-to teachers in this space at the minute, all these masterminders, because what they teach them about acquisitions, is knowledgeable, don't get me wrong, but it's the approach that they're teaching, like leverage up to 80%, and but it's just too much leverage. Whereas everyone's focusing on pre-acquisition and just getting the acquisition done. No one talks about post-acquisition, about implementing new teams, restructuring, making sure you can service your debt, ways what you can do to bring in new sales or manage your account for your current clients. Focus on them first before you get new sales. No one's focusing on the unsexy side of it, whereas everyone's like the easy side of the hardest bit pre-acquisition is finding the target, I think. I think appointing the lawyer, getting the financial due diligence underway and getting the lending, I think that's a pretty generic part of the process, personally.
Yeah.
Because it's pretty much limited within a set framework, But post-acquisition, there's a reason the stats at the moment are over 60% for why acquisitions aren't positive, and they're more risky and things like that.
And again, you go back to that sort of the unexpected. I worked with a business a little while ago, it was a freight business, and their main activity was they were trunking stuff into the main distribution hubs from Felixstowe. And they bought this business, big buy and build ambitions, and they bought the business, and they a significant amount of deferred consideration.
Yeah.
Debtor book, lending against debtor book, lending against everything with wheels on it. It was just cranked up to the absolute max. And they bought the business. About 2 weeks later, they had a second COVID outbreak in China.
Oh.
The amount of traffic coming into Felixstowe dropped through the floor.
Yeah.
Revenues went the same way.
Down.
It's like, oh man, this is difficult. Begged, stolen, borrowed in order to keep the business afloat, run up a big bill with revenue and customs, didn't pay the first chunk of deferred consideration. China comes back on stream, but everything is all over the place. We go into a cost of living crisis. So the level of imports from China is just down. So still revenues have come back slightly, but still way down on where they were at the point of the acquisition. And then all the dockers in the UK went on strike. So there was nothing, zero turnover.
And that's brutal, isn't it?
They lived through for about 9 months and then basically went into administration.
That's a shame. Yeah.
Nothing. And that was triggered by the vendor just getting so fed up about not being paid. He didn't care that it meant he got none of his
worries. It's
like, I'm just not having it.
That's what I mean. And that's why sellers, it's always because with sellers, it's difficult to explain the M&A transaction alone because it's like you're an alien speaking to them, right? Because it's not simple, is it?
Yeah.
Really, especially when we use acronyms, everything, and terms that they don't understand, and it's not simple enough, really, for your average business buyer who's just been in their business for 30 years and wants to sell. But one of the things is even harder to explain is why deferred consideration is there.
Yeah, it's kind of my on an SME transaction. My simple explanation is, and I'm not not a particularly bright person. Everything is quite simple, but it's if you buy a business for £25 million, right, the vendor has walked away with 25 million quid. Like, just say I know there may be deferred in that as well, but so he's walked away with £25 million. You're relying on a set of representations and warranties within the sale and purchase agreement that says if it's not quite what you said it was, if suddenly the taxman says, "Well, there's this old tax liability needs settling and it's not been picked up in your FDD," you know that he's got 25 million quid to make good. So you just call under your warranties and reps, and you'll get the money, no problem. If you've just paid him £400,000 and you know he's got a mortgage and you know he was looking to buy a place in Spain, chances are 2 days after completion, 397 and a half of it has gone. And he's not in the UK. You can't have the reliance on the reps and warranties, because even if you manage to track him down, he just hasn't got the cash to pay.
That's true. So
you just want something there that is, because it's much easier to not pay something than to get it back. It's
because
just simple.
Anyone selling, it'll be in their favour to we missed that, and it happens. It happens a lot. And warranties and indemnities can be written out by your lawyer, but like you said, if you actually call upon it, is it there? It's like certain clients that I've had in my businesses that don't pay. It's like, if they don't pay, is there any, you can call in the debtors and all of that, but can they pay the debtors? Can they pay the fees? It's a long drawn out process. What's the point? Just scrap it off. Loss, make it a loss, and then don't let them. Don't provide them service.
And that's why sort of things like, I always sort of say to people when I'm looking at M&A is even on a smallish transaction, the best one is ones where you say, well, it's only been making 25 grand a year, like for the last few years. Well, why are you paying 400 grand for it? And they say, no, it's because there's loads of personal expenditure going through the business. So if you put these ad backs in, it's actually making 100 grand a year or 150 a year, and actually it's a really good deal. I think, problem is, if that's personal expenditure, has he had a tax inspection? Because the taxman may get hold of this and come after you with
especially when it shows change of ownership, or then dive into it.
And so it's just a bit. So tax due diligence is always worth it's often not that expensive, because you just want to know it's got a clean bill of health and things like, when was the last inspection? So how recently is this actually? Because that could be because the taxman's got that ability to say, well, I've spotted it this year. You've probably been doing it for 5 years. There's your estimated assessment. And unlike any other creditor, can petition for.
That's it. Because you've got to start paying them back before you agree, because HMRC are quick enough to give you a letter to say you owe them, but when you've proven them wrong, them letters and them phone calls are very hard to get through on. I can assure you.
It's like petrol prices.
It's like I think this was a few years back on a business venture I started. I didn't go anywhere. I registered with VAT, had a few VAT. I think I missed some VAT dates, little things like I had some points put on and had some fines. But I was like, I've deregistered for VAT. But no, you got to pay this. I was like, the thing is though, I know I had to pay because it would just go on and then go against my name as a business owner, and I didn't want that. So I had to pay, although I didn't have to pay, but they got it wrong their end. But then it took like 2 months. Going back and forth and then I got investigated. I was thinking, well, what are you investigating me for? I'm deregistered as VAT because I didn't need to be. I shouldn't have been registered in the first place. It's because I thought this venture would kick on and go, but I'd end up just stopping it in the end. So I just deregistered it. But they investigated me and I went through the whole process. And it's like, okay, that's fine. But all these fines that I've paid, can you give me the money back now? Obviously, I've got it all back. But that took over 9 months. It's like, oh God, good thing I can afford to pay it up front. Because for people that can't, and then get in a mess, or people who start new ventures and would have that happen, that would put a right old salty taste in their mouth. With being a business owner and HMRC.
I think sometimes you kind of overplay, or I do. You overplay that sort of as an aspiring purchaser of a business. you're naturally got that entrepreneurial streak, which says, yeah, I'm prepared to take the risk. But this, at the same time, sometimes you just need to temper that and maybe take a leaf out of the book of some of the lenders. So you look at like a bridge lender on property, going back, like the good proposals to them is always, okay, because their two questions are, what's my loan to value?
Yeah.
And what's my exit?
Yeah.
So that's all I want. I want to know how I get out of this. And if you give them route one, exit,
give them
and another option, route two.
If you give them plan A, B, and C,
exactly.
Then you look like you've thought about the whole picture. Like, you need to stress. It shows that you stress tested it, and it is showing that you've thought about, if something breaks, then what do you do?
Yeah.
Oh, if one wheel falls off, what happens? Three wheels fall off. Can you pay us back?
Yeah.
And if you still can, by the skin of your teeth, then they'll be like, he's a golden
and
boy.
I think it's a good little thing to think of when you're making particularly your first acquisition, is if this doesn't quite go according to plan. We're back to the forecast again. If it doesn't quite go according to plan, what do I do then? And if it really, if that sale doesn't come through, what happens then? What happens if this doesn't work? And I think it's just having enough fat in the deal that you're not like literally on the bare bones at the
from
end
day
of the
one.
month. Yeah.
And that brings us back. That's why I don't do more than 50% leveraging, because there's no fat, there's no room for movement if you get stuck. Because if you're doing your first acquisition, 9 times out of 10 you won't have people or know of your alternative methods where you can draw favors from for cash to plug your business if you need that.
And also we've said that first 12, 18, 24 months, you are going to work so hard.
Yeah,
you're going to be so committed to that business.
Just because it's new, it's a new shiny object as well. So and you really want it.
You won't be getting the returns at that stage. But imagine how bad that feels if for the first 5 years of owning your business, all you're doing is flogging yourself just to repay someone else.
Yeah. And that's what people need to realise as well. When you leverage a business to buy it, it's not really your business until that debt's paid back, which on average, I think good acquirers say if you pay the business off within 3 years, you're doing well. I know some people who do it within 5 years.
And your typical acquisition loan is always a 5-year loan.
Don't get me wrong. If you can take a good salary from it to fund your life and the odd dividend, which you can manage, probably won't be able to, because you want to put that all back onto
and
the
a
payback.
lender typically will want a written dividend policy, because they don't want you taking cash that they see should be coming to them.
Yeah, it's true. Yeah.
And the other thing that people need to bear in mind is deferred consideration. Some lenders really don't like any deferred consideration until they're repaid.
Oh, right.
So you sometimes have to build that into the loan agreement, that the deferred is only paid with their say-so, their approval. So that can be quite.
I didn't know that.
Awkward. Yeah. They
shows I've never got lending.
Yeah, it's kind of like, we've given you this money, we want it back before anyone else starts taking anything.
All right.
Yeah, so it's it's
basically putting a first charge on it, isn't it?
Yeah, so everything they will be looking at, people often get. So obviously there's a question of personal guarantee, but typically a lender will ask for a statement of assets and liabilities.
Yeah.
Now that's partly to understand whether or not the guarantee that they take is worth anything, but parks or the negotiation of how big the guarantee is. But it's partly because if the person who stands behind, if the purchaser is actually up to his eyes in debt, has got other business interests that aren't doing very well, even though there's no legal group, and if he's committed, if he needs to be drawing £20,000 a month out of the business, well, that comes into my debt service calculation. So your business may have this EBITDA, but if I know that outside of that, you have got to take this much money a month to fund your lifestyle, well, now the business doesn't make enough cash. So it's that kind of thing. Is just a lender. It is this sort. Lenders are very, very cynical, very staid, very risk averse. So they want to understand the whole picture right from the outset.
So what would you say people obviously aspiring, what would they need? What would they come to you or a lender and have to produce?
So minimum is to get a proposal away, you got to have up-to-date financials.
Yep.
So last year end, latest month end, forecast.
What if they don't? What if the business doesn't forecast?
Then
Is that dead in the water, or
no? Because you can put them together. Look, a forecast. The big thing about forecast is people get very het up about whether or not it's correct. Yeah. Well, it isn't correct. It's just an opinion. Yeah. So if the business, if all else fails, get yourself a little model. A lot of advisors will have their own in-house model that it produces cash flows, balance sheets, P&L, all linked together. Just put in there last year's P&L and see what comes out. What does that business look like? And then layer in the proposed debt that you're looking to take, preferably with the structure that you're looking at. So that'll suffice. It's not a hugely challenging thing to do for a really complex business. Don't get me wrong. If you're buying a pensions provider, it's probably a bit more complicated. But and then be prepared to give a lot about your background, your ability to run it. What you're trying to build, as for when I approach the lender, you're trying to build a proposal that is saying, this is the business, this is its ability to service whatever debt. This is why you're safe on this. However, there are risks associated with this. You never tell a lender
anything. Yeah.
Never ever tell a lender there's no risk.
Yeah.
Right? You say, yes, you're absolutely correct. There are these risks, but this is why we're managing them. This is why you don't need to be concerned
if you
about
just go and just touch on that, if you never bought a business and you haven't got history in owning businesses, what's the best thing that they like to see?
I think it's
in that instance.
Yes, it's sort of some knowledge of what you're buying is always good. Obviously, you can offset quite a bit by the size of the contribution you make.
Yeah,
and I guess it's that sort of competence. It's just presenting well to be a credible person. It's like, the first time after your first kid is born, and you and your other half decide, actually, let's have a night out. We haven't been out ever since whatever, Jemima or James was born. So why don't we go out for a night? Oh, we need to get a babysitter. Okay, we get. So the babysitter turns up, and you think, well, I don't like the look of him. I genuinely don't like the idea of it. Yeah. That is exactly what a lender is going through.
Yeah.
Do I feel that I trust this person?
So aspiring people who've never bought a business, don't have no money to inject, right? I know I shouldn't really say this in this instance because you need to bring money to it, and they don't have any experience in the sector. So say they come from a construction background, they're trying to buy an IT business. So how do you present yourself then? Like,
it's a tough one. So it's
difficult. Yeah.
It's because the way you do it is back to this thing of risk. And I know that's a really sort of nebulous sort of word, but it's kind of why are the obvious risks that the lender is seeing? Why do they not need to be as worried about it? So the big one with the first acquisition, I always think is like baby steps. Just do the little things first. Yeah. So get a couple of those under your belt. One of the other ones that people sort of seem to I guess it is a sort of technical point, but is when they've got a hold company that's coming in to buy the business, is when a lender lends money, there's no surefire sign that a business is insolvent anywhere in the Insolvency Act, anywhere in company legislation. But there are various badges of insolvency. So the ones that people are most familiar with is an inability to pay debts. That's how you petition to wind a company up. But one of them is a negative balance sheet. That's a symptom of insolvency. So if your purchasing business borrows money, is the balance sheet actually solvent at that point?
Yeah.
Because if it's not, technically, the charge that the bank takes to secure its debt could be invalid, could be void. And that's why so the banks in particular often will look at the balance sheet of the purchasing business and just say, and so you've spent, in some cases, weeks and weeks and weeks putting together a proposal all about like the purchase business, the forecast, everything stacks up. Actually, we just can't lend in here.
Yeah, so it's dead.
Because actually, I don't think our charges are valid. So there's a
does that happen often?
It does at the small end where there's no capital base. So it is difficult, and it's always as the external party purchasing. there's that's just a slightly higher kind of risk threshold.
Yeah.
And that, to some extent, what you do with that is you go to the lenders that have more appetite, but then you're into the realms of then they charge more money. That it's kind of in some ways it's like if your option is to bring in an investor, but private equity and VCs aren't.
There's a few years back, I come across this chap and he's telling me about his story about how he got into it, and he said he didn't lend for his first 10 acquisitions. He goes, his go-to one was he went to his accountant. I think it was a quite large corporate accountant, so he had lots under his control. And he goes, I want to make this acquisition. Do you know any other business owners that would want to do me a loan for 1 to 2 years? And I'll give them X amount back.
Yeah,
of like 10%, I think he said he done. And he done it that way.
Yeah.
I thought it was a brilliant way to do it.
Yeah.
You know, especially, sorry.
Yeah, and it is.
And I've never heard that until him. I thought, yeah, it's a really good creative way to.
But if you and you can sometimes bring in sort of angel investors, and there are people who do that.
I remember in my early property days, I started going, right, I need an angel investor. I mean, I was very lucky. I got the guy who I acquired off. He was really an angel investor of mine, and then another family member of his was as well, and they had big pockets. So I was very fortunate. I sort of had my own debt facility on hand, but other people, for searching for other angels when I was like making the step up to like commercial to residential, like flat builds and stuff like that, I couldn't find any, even with presenting like a 5-year portfolio experience and stuff like that.
It is really difficult.
I think that's just my...
No, because I
know a lot of people in property who have angels and like, they're like the best thing ever, you know.
Yeah, and it's just, and it will be someone that you know, or like you said, that's quite a neat one. The industry insiders, that they will understand what you're doing. And if you bring someone like that on board initially, and like I say, if you got one of them, there's a world of difference. That from a lender's perspective, they will categorize in terms of risk, management buy-in. Don't really like them. Like I say, a lot of lenders just don't do it.
I'm surprised
management buyout they like because it's all there's continuity.
It should just be an easiest transition with any.
And then
business.
Somewhere in the middle we have the corporate acquisition, and the corporate acquisition is just the stronger. Corporate acquisition is all about they start to, if you had a business that turns over 500,000 buying a business that turns over 50 million, that's going to be a little bit difficult. Have you genuinely got the bandwidth to run this? And so that's why I think sometimes you got to look at doing those smaller transactions. At the end of the day, if you're my age, it's probably your timeline's a little bit shorter. But if you're in your 20s, in your 30s, and you're looking at your first acquisition, you've got time to actually make 2, 3, 4, 5 acquisitions before you're thinking about an exit.
And then I say this to a lot of people, like they say the bigger the business, the easier to acquire. It's like, unless you got the money, no, it's not. But there's nothing wrong with like getting a few businesses that turn over like $750,000, like on paper. Yeah, okay, that's fine. But if you bolt 2 together, 1.5 million. That profit should be anywhere from 250 grand to 500.
Yep.
Really, because it's a owner dependent man running it with a few team members, you know, and then you can evolve it that way. You've got a platform there
and
to evolve.
You look at the way the multiples tend to work. So it's a very sweeping statement, but below $1 million of EBITDA, you're probably looking at what, for a stock standard sort of business, 4-5 times earnings.
Oh yeah,
go over $1 million, and suddenly you're looking at 7, 8, and so without doing anything other than bringing those 2 businesses together, suddenly the combined business is worth more. And that's the game that you need to be into and thinking, okay, so what I need to do is I just need to get my first one. My first one is going to be my most difficult acquisition.
Always, and
and then just build. Then you could, and it's almost like all you're doing there is paying your subscription fee. The second one, you start to pay your membership kind of thing.
No, that's
really
right. And people need to stop thinking, I'm going to buy the perfect business for my first one, because you're not. I wouldn't strive for that. If you can afford to put down the 25% to go with the loan, then yeah, you can look for a business 3-5 million maybe turnover. But there's nothing wrong with £1 million turnover business looking to acquire that, because one, you'll get that on you should be able to get that on all but deferred with maybe it's 100 grand down, but you can leverage that business 100 grand easy, or leverage someone to borrow you 100 grand if you can do that. If you can't, then you got to go 100% creative. You know. But there's nothing wrong with that. But once you get that underneath your belt, the amount of doors that open from having that one is tremendous. And it's just getting on that saddle for that first one.
There's a couple of things sort of come to mind. There is you've always got the option, and people, this isn't. Yeah, you can't. There's no. The thing that I think a lot of people are trying to find all the time is this perfect solution. And like, someone did this on this business acquisition in 2024, and therefore that's the model that we use to buy early business. Every business every transaction is different. It's all really nuanced. And so one of the things that I've seen people do, and it is, it's a kind of long conversation with your partner, but is you've got some of the bridge lenders who will lend against the equity in your property, plus they'll do a lend against bid, so they provide the business asset funding as well.
Yeah.
Now they're going to be expensive, but once you're the owner, it's just a simple refinance, and there's all sorts of other people who are in the market for a straight refinance of a business you already own.
Yeah.
And that removes a lot of the questions about how much are you putting into it.
The thing is with that is, I understand that, you understand that, but a lot of people hate the word debt, let alone loan. And they don't,
on my own house.
Yeah, refinance, like PGs. All of them things are known as the devil. But in reality, as long as it's calculated and you understand what you're doing, then you can do that. And if you don't understand, just ask a professional.
Yeah,
ring Shaun.
The team at Goldfinch Finance.
Yeah, that's it.
Yeah. One of the things I was just going to pull you back on is you said about when you see the perfect opportunity. What's the perfect?
It doesn't exist. The perfect opportunity is getting given a business by your granddad that turns over 10 million. That's the perfect opportunity. Yes. But I don't think, people think the closest thing to perfect opportunity is getting a business to pay for itself, have middle management so you don't have to do nothing, and you take $500,000 a year out of it. That's a perfect opportunity. I don't think it exists.
I think the opportunities that I think are really interesting is, you're probably like me. I'm it's a really conceited statement, but I just think you can spend about 20 minutes in a business and you know whether it's a good business or not.
Yeah,
you can just feel it.
Yep.
And it's the good opportunities, particularly for your first timer, is the one where when you do that 20 minute, when you look at the business, there is a glaring problem that they're not addressing, but you have everything you need to sort that out. Those are the really great, because that is where you're going to instantly add value to the business.
Yeah, because I'm a bit like that. I refer to it as like, I would rather buy a growing business or something I can grow rather than something I can just say, right, I can just show off with. Like, I would rather take something from £1 million and say, right, I want to get to £10 million within 5 years. And then, so that means I can take that business. Because when I look at businesses, because I know that I'm never going to buy a perfect business, because one, you're paying a premium for it. So what's the point? You're not adding any value to it. So you're overpaying for something just to stay as it is and to stagnate. Different story if you're a big multi-million pound business and you're trying to fold something in to get a new client base or something, that's different. But from my world of like sub 20 million SME, I would always prefer to get £1 million business foundation, which pretty much you're just buying trading history, a bit of a foundation, a bank account, credit number or credit status. And then from that, you can then go in any direction and you can add in your own things, because it should be lean enough at that size, you can make a real difference. Because the bigger the business, if it doesn't function how you want it to function, you try stripping that apart and making it function how you want to function. It takes years.
Yeah.
Because there's so many moving parts. There's so many people in it. You can't just fire people because people, HR and all.
Yeah.
So it's more difficult to scale a mid-sized SME business than it is the smaller one, and take it in the direction where you want.
And it's just sort of looking at that business and thinking, there's a simple change I can make. This is not a great example, but there was a guy I worked with just at the end of the first lockdown, and he bought an off license. And
God, that's the worst business you buy out for. Yeah.
But one of the things he did, it was in quite a nice affluent place. And one of the things he did was Friday, cocktail of the week, every week. Come in, I'll show you how to make a cocktail.
Yeah.
So your guy comes in
every
Friday, buys a bottle of gin and like half a dozen cans of tonic. This week, cocktail of the week is Negroni. So
Fair enough.
Equal parts like sweet and vermouth, Campari and gin. We sell all three of those.
Yeah.
So he goes away, he doesn't buy his bottle of gin and his tonic water, he buys Campari, vermouth as well. But next week, margarita. Next week.
Fair enough.
And you just go through like that. And so you just prompting people. It's like simple sort of upsell.
Yeah.
But
innovative.
Loads of takers for.
Yeah.
And it's little bits and pieces like that. In some ways, that's not a great example, but it's like that sort of thing of, what is it this business is lacking that means it could perform so much better? And sometimes every sales pack I see at the moment always says, just a minimal amount spent on marketing.
Why aren't you doing it then?
Why is that?
Why aren't you doing it then? And that's why I always say is, why aren't you doing it?
Yeah.
That's why, because I've got a couple of mentees now, and I'll say, and they're going through the whole thing of just dealing with on-market listings. And I'm like, the IM is a base point. There is plenty of lies and fabrication in there from the broker who is over-inflating it. I jumped on a discovery call with one of my mentees the other day. And this guy goes, I think it's for a manufacturing business. And he goes, so what we're expecting is, he wanted us to send over an indicative offer before, because the broker wanted to talk to us before setting up a discovery call with the seller, because he was questioning the mentee's background. But the mentee's background is, he's very open and honest. He's like, I've never acquired a business. I've run a business. I'm now an employee. I'm looking to make my first acquisition. And I jump on discovery calls with him as I say, I'm a future board advisor. This is my background, right? I'm not involved in his business. I'm simply just an advisor advising him. Obviously, this is my experience. You've met him, Lysander.
Yeah.
Because he's obviously come to you to get some, because now he's sending out indicative offers. He wants some lending advice. So he's doing that step. But he was trying to dictate multiples already with this indicative offer conversation. He's like, but the indicative offer, we're seeing multiples of 5 to 7 in the market at the minute. That's normal. I was like, that's not normal for a start. To say his name's Jermaine. I was like, Jermaine, that's not a standard multiple. I was like, anywhere from 2.5 to 4.5 is standard, not 5 to 7. I said, he goes, well, it's always up for negotiation. I was like, yeah, I understand that. I'm just saying, please don't try and dictate, obviously, just to drive the price up, because he might be green in the situation, but I know what the market does and what's normal, just like you do. I know you're trying to get what's the best price for your client, but we're not here for right.
What's your thoughts on a tactic? Actually, a purchaser that I dealt with a couple of years ago. His approach was he buddied that. He got sort of, he saw a lot of stuff from a couple of the big brokers we won't mention. But business brokers. Yeah. So he got quite pally with them. And then he just said, look, all I want the IMs that are 12 months old.
Yeah.
Because actually,
there is
the idea is you can have a much more realistic discussion about valuation.
Yeah, because for the first year, they'd have gone, if they're still on market for more than a year, which majority of them are with the big boys, because they're not incentivized to exit. They're incentivized just to list and leave them with young account guys. So if they're over a year old, they've gone through all the crappy. They're frustrated because they want to be locked in with heads of terms going through due diligence. So, but then, yes, if they're more than 12 months old, but then they can be very rude and rigid as well. On the other hand, like I know another one I was looking at 2 years ago. This is with Transworld, who are a good broker, by the way. Transworld, they don't charge an upfront fee like all the rest of them.
Yeah.
I think they're all back end. But no, I know, yeah, there are some pretty good guys in there. As brokers go, probably one of my favourite, really, from actual brokers within their businesses. But this business has been on 2 years. I put an offer on 18 months ago. No, probably a year ago. Just over a year ago. Year to 18 months. No, it's too late. It's been running for a lifestyle business. Wants too much money for it. Fine. Stay where you are. That's fine. My mentee, Lysander, put an offer in back into last year. No good again. It's still on market to this day. I had an email from the broker of Mr. K about 6 weeks ago. Oh, he's back on the market. Would you like to open up another line of communication? No, thank you. Because I know from the mentee that he still wants too much money than it's worth. And since on my offer, it's dipped a bit as well. And he still wants the same stupid money. But I know because I had an in-person meeting with the MD and the accountant in the accountant's office. So he's pretty much the accountant run the business and dictated all the terms. They're really silly terms. And yeah, a business that was probably worth about 1 million. He seemed to want like 2 million for it, 2.2, because he thought I paid for enterprise value multiple. He thought on top of that, I bought stock, which you do buy stock. And then he's like whip, debt book, all this other stuff I buy. And obviously I had to use him as an accountant throughout the deferred period. And I just got the wrong instinct and vibe from this accountant. I just didn't like him. And I was like, no, it's not going to work like that. And I actually accidentally overvalued for it. So I should have offered about 8,500,000. Excuse me. But I liked the son, who was the MD. He was a really good guy and I could really work with him. He was just restricted by daddy. Daddy just used it for 200 grand a year and he lived in America. Simple lifestyle business. He wanted it to stay at its place where it was, but it's got had all the links to go and grow and whatnot. It was spread over 2 locations, really good infrastructure. The son was like 20 minutes from the yard. He was like die hard, get there at 7, leave at 5 sort of thing. But it just didn't come to light. But yeah, going back to it, that's a good, if you want to see mandates for anyone looking to buy businesses, speak to brokers and say anything that's been on your books more than a year, because them guys, you probably won't get a creative deal for a broker, like a big broker like KBS or anything like that. But you could do, but 9 times out of 10, they'll always advise them no. But you might get a more realistic multiple. Yeah. Because because the seller will just want to get rid. Yeah. It depends how frustrated and how quick they want to get off. But in caveat to that, the longer they've been on the market, because as soon as they list, sellers naturally take their foot off the gas and off the boil. So you're sort of always buying a sort of not damage, that's the wrong term, but
it's often dwindling. Yeah. And they won't be investing.
It's declining anyway.
They won't be replacing bits of kit if it's
they'll be stripping costs back to make it look just to try and maximize it. And then probably what you inherit, if you don't get the opportunity to talk to middle management or staff, which you don't a lot of the time anyway, then you're buying the risk in that as well. Yeah.
And it all is, I know that,
but it's all risk anyway. Anyone coming into acquisitions, you are buying one big fat risk at the end of the day, and you need to realise that.
It's like buying an Alfa Romeo.
Yeah, literally, or a Land Rover.
Don't get me started.
I was telling you off camera, wasn't I? I had 2 earlier on in the year. Well, one I bought and was after a month I'd send it back, and then they come back after 8 months still smoking. That got sold, and then the other one that we had for like 2.5 years, I went to chop that in for the new car, and I was like, yeah, we can't take it. They pull it up on the ramp and checked it. It's like, it's got 9 faults. I was like, we buying a car, mate. Just dead it. Lucky it was the kids one, so it's a bit older. It was just this poor neglected disco.
Yeah.
But no. So yeah, tell us about Goldfinch anyway. So obviously that's your
So yeah,
latest
so
venture.
it's my own business. Yeah. So but my first venture into being my own boss. But,
yeah. How are you finding it?
Interesting.
Yeah.
It's quite hard work. I mean, I enjoy it. I just love business, and I love, obviously, I bring my experience of finance into it. So it's like we're talking about acquirers. You need to stick in your lane really, and do the bit that you understand.
Yeah.
But yeah, I could just talk business to people.
Because that's the good thing about you is obviously I think I was introduced to you by other people in my network. So the good thing about Shaun is he's not just your commercial broker that'll just broker you alone. He can help you, like you said, with finance, financial reporting, forecasting. He does the whole.
Yeah, and it's the
whole package, which is good. I think.
I sort of split between. So it sounds sort of complicated, but it's not. The debt advisory and broking, and the simple difference is that as an advisor, you're paid by your client. As a broker, you take commission from the lenders.
Yes.
Once you're into the world of acquisitions, a lot of acquisition finance providers simply don't pay commissions. So you need to be very upfront about that. So I'll typically say, okay, I'll engage with you as an advisor on the basis that for success fee, if the lender pays commission, then I'll take the commission instead. So there'll be no success fee there. And which is fair. It's going well. I'm a generalist, so I don't specifically look at any one area of the market. So I tend to shy away from buy to let. A lot of the lenders in that market are now sort of dealing really with packages, and so to me, that's just, as a broker, I'm giving really poor value to a client if I take a commission from a packager who takes a commission from the lender, because that's all being doubled up in the rates you're being charged. So if I come out of that loop and I just say, you need to speak to this packager.
Because when people who don't go to brokers, you either get brokers who just work off commission, who have a partnership with a handful of lenders, and they will force feed and give you them. They will tell you what the maximum lend is without acting on your behalf. Whereas people like Shaun, they don't have the commission. They work for a fee, so they work in your favour and get you the best deal. With the relationships they built with lenders themselves.
And
which I think is better and it's more ethical.
You look at one of the high street banks in particular is pretty famous for it. So in the mortgage market, so they're not particularly good. They're not great. So over time, they tend to see their referrals drop off. So they double the commission for a 3-month period. Double commission. And suddenly they get loads and loads of introductions. Now, hang on a second, it's still quite a poor product for the client.
But it's getting pumped in the people's face because
the guy's getting twice as much off it. And that's just wrong. So it's and it's kind of, I think at the moment, the challenges with a lot of clients is you can't give them the comfort because it's uncertain. People are not. The lenders aren't falling over themselves to put money out.
And I think that'll be the way moving forward forever, or definitely in the next decade, because it's stemmed from 2008 crash. I think since then it's been loan to values come down, because for people who don't know about the property market, obviously the big crash was heavily influenced by property developers who were getting 125% loan to value from 2000 up and over leveraging and just killing the market.
And that crash did have a big influence on the M&A market. So in the run up to 2007, 2008, I was working at an asset-based lender, and we were doing huge amounts of transactions around M&A. And then suddenly you start, there's always an issue with using debtor finance in particular. So debtor finance is going to be a percentage of what your debtors are.
Yeah.
So on the day before completion, if one of your major debtors pays, the debtor book's not worth as much. It's not going to get as much of an advance. So you would hope that will come out in the regular working capital, sort of calculated cash. So it would come out as surplus cash. But you have that problem. And in the run up to the crash, like I say, it was being used a lot, but you started to creep in once the things all falling apart in 2008. What you had was transactions that had been worked on for the preceding 6 months. Suddenly you get to completion and the inventory wasn't there, or it wasn't worth it. The debtors weren't there, and the market to buy secondhand CNCs.
It's never been.
So the amount that you could leverage out of those assets was dropping, and so asset-based lending sort of fell away quite a bit as a method of funding. But it's purely because it had all got too frothy and too easy.
Yeah.
So and it's still one of the options. That's
say a business has 100,000 worth of assets. What's the maximum you could lend up to on that?
So what I tend to look at is most of the asset-based lenders, the ones that do a broad range of assets, it centres on the debtor book first.
Yeah.
So your debtor book, typically 85, maybe at a push 90%. But
that makes me.
But if you're taking all that money, and the debtors, the thing that you've got to remember is, with a loan, someone comes and gives you a big pile of new money that you then spend, and you spend the next 3 years or 5 years paying it back. With debtor finance, invoice finance, there's no new money. You've just grabbed hold of what you're going to receive.
Invoice finance facilities instigate that when that money comes in, it goes straight out to them as well.
Yeah.
So
when the customer pays, it has to be paid to them.
Yeah. So
the only thing you can do is keep drawing it. That's why it's like the crack cocaine of the debt.
It gets you in a facility that is very difficult to help, and that's why.
But it's freely available.
Yeah,
and often it's reasonably priced. So you use your debtor finance, but you don't want to use too much of it to fund the transaction, because that's going to be working capital as well. So it's sort of 85 to 90%. So when you're forecasting, say 80, but you wouldn't even want to be using that. Then you've got ignore inventory finance. It hardly ever works. And your inventory finance, stock finance, hardly ever works. It's quite expensive. It's very clunky.
Well, really, and your working capital, you want to calculate and then throw the stock in with that anyway, so you don't have to pay for that.
And then you've got asset finance, typically 80% against its value. And then property, if you want to do that sort of on a commercial premises, probably about 70% LTV. Yeah. But then if you go to the right lender, some of them will then offer a cash flow loan, a term loan on top. Those are typically, because essentially they're unsecured because they've taken all the security that's on offer. So those are usually limited to one turn of EBITDA, probably 1.5.
So this
maybe.
is another thing I was going to come and ask you is about the EBITDA loan that I've heard all things about on Google, but I've never seen in reality.
So that's just the metric they use. It'll all be based around a detailed forecast about what's the free cash.
Yeah.
But on a real nuts and bolts basis, your earnings before interest, tax, depreciation, and amortization. So depreciation and amortization is a book. This is an accounting entry. Yep. So theoretically, there's no cash involved there. So you add that back. The tax you add back, don't ask me why. So you add back tax and interest to get to like what cash that business is generating that would be available to service debt, because obviously that's where the interest comes out, because you look at your debt. I always say, okay, if you're going to take that approach, you want to take 20%, 25% off of your EBITDA, because you are going to have to pay the tax.
Yeah, of course.
Yeah, so it just, because you always want to be slightly sort of pessimistic about how much debt capacity the business has. So across those classes of assets, you've got quite a bit available there. You can then take a small term loan, but those typically would be quite aggressive repayments. So maybe 18 months. So you wouldn't want to do as much as a whole year's worth of profit. No. And then there's a few in the market that offer gross guarantee scheme loans. And that's your 5-year money with the benefits. So those are quite useful in an acquisition, because the way it's painted to the British Business Bank is we're using the receivables, the debtors, and the assets to fund the transaction, but that leaves us short of working capital, and so therefore we need a gross guarantee scheme loan, because you're not technically allowed to use a gross guarantee scheme loan for an acquisition.
Use it for post.
Use it to fund the post. So
that to me just sounds like just too much for a business
But
to handle.
But you are literally
Like, where's the money left for? I mean, does the growth? Yeah, you got to have a good growth plan for that growth money to warrant itself. And then, is there any money left for the actual person who's acquired it?
And this is why it's important that you've got to discuss. How are you going to be paid?
Yeah.
You need to, because everything is in there. Everything's wrapped up.
Yeah.
So, or you go down that term loan route, which is more painful.
Yeah, it takes longer, doesn't it? I think.
But again, 5 years. Normally 3 to 5 years.
It's a big cloud over the business's head, and if you don't succeed in growing it, then it's a bit.
And often covenants in there that will be earnings, usually something like EBITDA. Or a debt service calculation that's agreed in the format of the loan, in the wording of the loan document. And they'll test that maybe quarterly.
Yeah.
And if you fall over, event of default,
where you go into that realm of things, which is, leverage. I don't like it. It's necessary. It can be a good tool, don't get me wrong, but just do your homework on it. That's all I say to anyone. Like, don't go into it naive thinking, I'll borrow that and then I'll have that paid off within 2 years, like you do your normal stuff at your house. Yeah. Because with business, there's a lot of moving parts. Within 1 quarter, you can go down, and then you can take another 9 months to recover. And then all of a sudden, your original plan is out the window, and then you got 6 months to recover a lot of money, or to stay.
And the worst ones are those sort of seasonal businesses.
Yeah.
Where you've got to run that on whatever your cycle is, whether it's 6 monthly.
And if you've leveraged next to everything else to get your down payment, to get the business, then you got to get in that business yourself, roll your sleeves up and go on the sales front.
And it's the other one that comes up again, talking about invoice finance in particular. So you got that seasonality. So if you've got covenant tests every quarter,
two of them, two are always going to be down compared to the other two.
Do you actually pass it every quarter? And the other one is on invoice finance, is you go even in that seasonality. You've still got the same thing about what's the availability of the line in the low periods. The other one is what gets called intra-month or mid-month swings. So a lot of businesses, all the cash goes out of the business at the end. So it's invoices. Your sales invoice is what creates the availability of funds. You tend to have a big push on invoicing last week of the month, but all your money goes out the third week.
Yeah.
It doesn't match then, does it? So how do you get through that?
Just going back to another thing you said, that's why when I go to my businesses, sorry, that's my kids knocking on the door, it's being idiots. My non-negotiable is 6 months working capital left in.
Yeah.
Because I want, if it's a good business and it stands the test of time, because my personal approach to business is at least decade old, or the longer the better. So if you can't leave 6 months in, then you are not interested in the benefit of that business to survive and survive for you're deferred, and 2 for your people, which I want to inherit and improve as well. So that's my approach. I will take nothing less than 4 months though in negotiations, because I want 4 months left in.
Yeah.
And that's nothing to do with anything else.
Yeah.
But that's a massive stumbling block. When on market brokers, all the big boys, they say it's normal just to leave a month in. No, it's not. Who leaves a month working capital in a business? Like, you're literally, if you leverage a business and then have 1 month's working capital in, you're on the breadline, like from day one. And if you've never been a business owner before, there's no time for you to be insolvent, because that can come fast if you don't know. If you get the team not respond to you, or everyone just goes, the owner's gone now, right, let's see what this new guy do. I'm just going to sit back for a few months. All of a sudden, month 3 goes by, you're insolvent, mate.
Yeah.
And there's a reason. And that's why I say 6 months. And people might not like that, but I think it's best for both parties and both sides, especially for longevity. Like, my personal acquisition is like a long-term HoldCo. So it's got 20 years to run. So how I pitch it to business sellers, I say, if you want to hand the baton over, then you're going to hand it over for like 20 years. I'm not looking to force exit businesses within like 5 years, like a traditional buy and build. It is a buy and build, but it's long term.
Yeah,
So
which is quite a popular model in the States. You see a lot of sort of small equity houses that their model revolves around typical sort of hold, whereas in this country you typically see PE go in 3-5 year cycles.
Yeah, I think it's
it's longer, sort of 7 to 10. And what you see a lot of is people building a group in an industry. So it's back to that multiple arbitrage that you get from profits below $1 million will earn 4, 5, 6 times. Profits above $1 million, suddenly it leaps to 7 or 8 times. And so they're playing that game. They just build these little groups.
Yeah, so my business plan is to get it to, in 20 years' time, like group turnover of 100 million, and then to have the EBITDA over 10 million threshold.
Yeah.
That's the plan. And then that's when the big multiple, that's when PE will want it, because it will be in construction, and some of it might have pivoted into manufacturing engineering at most.
Yeah.
So it'll all be industrial sort of thing, which
Yeah.
I know has lower multiples anyway, but that's my bread and butter. That's my background. That's what I love and want to do. So yeah.
And the other one, just on those first time acquirers, often those market brokers all jam tomorrow, isn't it?
Yeah.
You're buying and trying to argue the multiple up by buying this opportunity. It's the opportunity to do something.
Yeah.
Number one, my mantra is like, you don't buy your own potential.
No, it's right. Yeah.
But the other one is if the vendor is so adamant that this business is going to fly once you own it, well, why doesn't he just say stay in with 25%, 20%?
That's it. There's nothing wrong with that.
Yeah, I'll only buy you out 75, and you can come
that's what I say to a lot of people as well. Is like, you might want them on, you might give them 25% equity or leave them in there, and they can just be your chairman or your board advisor, for example. There's nothing to say you can't grow the business over the 5 years and then say, right now it's time you get a second bite of the cherry. I want to buy you out, please.
Yeah.
Or I want 10%, and you do it in increments.
Yeah.
And there's nothing wrong with that. You just got to it's just getting into bed with the right person, because as good as that can be, it can also work against you if they want to tank it. Yeah. But then they shouldn't want to tank it because they're still in bed with you. So yeah, it's different conversation for a different business type. But no, there's nothing wrong with creative. Like, people want 100%. Like, no one wants to share the pie. And my approach is, I would rather share. So my go-to is 75% ownership and 25% equity stake to the person operating it. That's my go-to.
Yeah.
Obviously, they have to get to a certain point where they get that in proper shares. But until that point, till they've proven it, they've come on the journey, then they get a profit share, they get B shares, other things like of that nature. And then in my head, I say, if they get to year 5 and they're still on the same point and they're growing in the trajectory where I want the business to go, then they can get proper shares. I've got no problem with that. I'd rather do that.
Yeah.
And they can still get profit share and a good salary, because that's their incentive. They might work better as that. And then, but also there's been a handful of people in my businesses that have been like, because I've always been open and honest about what I do with my acquisition journeys and my overall goals. I mean, I was saying to my internal team for my first business what I was doing for years. I was planting seeds in heads for like 2 years before they come to me with an offer, because I knew that was the only way I could be bought out. And the guys, I only agreed to it because, one, my personal situation, I needed to step off. But 2, it was their last opportunity to have something of their own, because they were like mid to late 40s, the 2 of them, because it was like 2 contracts managers that bought me out, with the backing of, I think one of them had a bit of inheritance and one of them had like a rich uncle or something like that. And so they come to me with like an offer, and I said, the business won't handle it, so this is my counter. Only worked better for them.
Yeah.
And I'm like a board advisor to them now. I simply just touch base with them every couple of weeks and see how they're doing. If they got any questions or want any advice on how to talk to some of the architect relationships I built, then I help them with that. I've got no problem doing that, because that's my original baby, and I'll never turn my back on it. But as for the other the other one that I said I exited, he's on his own, rude bastard. But no, it's been good.
Oh, that's right. It's like a good deal. It's a deal where everyone walks away thinking they've got a good deal.
Yeah. And I think people on market mandates are always hard to negotiate because they've been sold this pipe dream from the broker. And that's what I don't like. That's why I do it slightly different in my brokerage. So, my business model for my brokerage, you do pay an upfront fee, right? Because it takes time, costs money for marketing to withstand my network, my private network and things. But I'm incentivized to sell your business.
Yeah.
But like business owners that come to me, I openly say, like, this is the standard multiple for your enterprise value in your industry. This is what you can expect to get. But at any given time, you can get less for that, depending on market rates, appetite, depending on what size business it is. Well, it can be more, but we can drive it up. Excuse me 1 minute. Babe, what are you doing? Yeah, darling. No, go inside, please. Sorry, it's just
That's all right.
Just a baby knocking the door. Yeah, sorry, where was he? I'll edit that bit. I probably won't. I'll just leave it. Giggle. Where was I?
You're talking about the guy that exited that you just kicked to one side,
Yeah.
and the management, the two guys who you sit in as a board advisor still, and just
Yeah, so like some people think, they just want 100% of everything for no reason, and I think you need to. Yeah, there's no harm in sharing the pie around.
And like you say, the on-market brokers are just a bit more.
Oh, sorry, yes, that's what it was. Yeah, so like in my business, I sit down with clients and I say, this is the industry average. You can expect this. This is, it's not given. It can be slightly less. It can be more. It depends on appetite at the time. Depends on what time of the year you go to market, believe it or not. Because obviously financial years is obviously you want to be going... I think you want to be the great time to be marketing a business is probably anywhere from Q2 to Q3 because everyone wants to be closed by March. Everyone wants to, or then have the figures for the next financial year, April, May time. Like that's the one thing I say with all my clients in my brokerage is I give them the textbook answer and I say, but this is reality. Expect to be paid what someone will pay you. I can't guarantee you 5x like in construction, engineering, manufacturing. I say anywhere from 2 to 4 times multiple. That's what I'd expect in the sub 10 million turnover range. If you get more than that, brilliant. If you get 2x, you can either take it or you can stop and come back to market at a later date when the appetite's there. I think what I'm seeing in the last year, though, there's a massive appetite for industrial businesses and construction businesses. So where we specialise in construction, manufacturing, engineering, I think we're going to have a very good next few years because where we're coming into the digital age and tech is actually gone down slightly and PE has actually moved a bit more to like asset-based sort of like real-life businesses. They're all coming.
Look at
they're all coming over, which is brilliant for me.
Yeah, and I think people have. There's only so many. There's only so many times you can talk to a lot of the investors. There's a lot of fail in that market.
Although tech is the sexy multiples, sexy exits, it's got the biggest failure rates because of that. Because everyone's been pumping tech for the last 5 years, it's so saturated without it knowing. And with AI, how it's advanced now, AI is creating tech, and so tech's going to go down. I believe in the next 5 years, like multiples and exits, and
also it's almost
if
you're developing an app.
Yeah, it's streamlined itself so much. It's got to the point now. It's gonna.
So someone develops an app. It's not necessarily how good the quality of the app is. It's how much you spend on marketing to get it out there to get people to buy. It's kind of, there's a lot of follow-on stuff after someone's actually done the work on the tech. But
so I was reading something the other day, like apparently ChatGPT is going to go down at the minute. That's the next one to go down. And it's going to be like, its cash is going to run out like mid-27, unless it changes something. But that's because Claude is taking over. And at the minute, like Claude is coming in with like really cheap. Like if you get a year subscription with them, they're really cheap. But Claude's taken over because it offers more than what ChatGPT does and all this other stuff.
But some of them, I just find that whole sort of market just bizarre. If you ever read the prospectus when Deferred listed,
I mean,
it actually said in their investment prospectus, we don't know when we'll make a profit, or indeed if we ever will. And you got people investing in it.
Yeah, it's crazy, isn't it? Yeah, I don't know. The whole tech industry baffles me. If I'm completely honest, you've got nothing there. You're cloud-based now, but your multiples are huge. Like tech multiples used to be like 15, 20 to 25 multiples. Granted, they come down now to like, but they're still like where construction's like 2 to 3, for example, they start at like 7, 8, and go to like 12. And it's like, what are you paying for? I don't get it. Yeah. The only thing I can understand is obviously if they're on a subscription-based model, then that's really good.
Loads of them are just loss-making.
So it doesn't make sense.
The revenues increase on the subscription model, but they've got to increase for a lot of years before it starts to.
But then also there's, I think, with the way it's going, I've heard, I don't know how true this is, the infrastructure to power it, there's not enough power for it, and they need like apparently like nuclear plants and things like this to actually warrant it. But no one wants to build nuclear plants in the world, so who knows where it's going to go?
Yeah, maybe that's where the answer is. Construction in the nuclear.
So, but no, going back to Goldfinch. Yep. So we've touched on how.
So we have a similar sort of model to you. So it's basically, I'll ask, even on a straight broker deal.
Yeah.
Then I'll ask for a commitment fee from a client, and that's pretty modest. A few hundred, purely because experience says, if someone isn't prepared to pay that, but particularly on the fee-paying ones where you're doing advisory, someone won't pay a fee at the start of the engagement or a monthly retainer, then they're going to argue about the success. Yeah. So, and monthly retainers, again, it's pretty modest. I don't know. It's sort of, I think the highest I've ever charged is 1,500 quid a month.
Yeah.
But and I only ever charge it for 3 months, because if we're not closing in on a solution in 3 months, I've got no right to be charging.
Oh, fair play. No, that's good.
So a lot of advisors will ask for that fee for a minimum of, say, 6 months.
Yeah.
No, that's great.
So I know some sell-side clients, right? Sell-side brokers, sorry, like independents, they do like monthly retainers. They do listing fee, monthly retainers, and then a closing transaction fee, which I think is like daylight robbery. Like, don't get me wrong, like these people will get clients, and I just think, what are you doing? Just sell someone's business for them. I'll get listing fees all day long, right? Yeah. But you don't need to charge them a monthly retainer and then get an uplift of their transaction cost. Yeah. Well, I think that's a bit much.
And it's just kind of getting that balance right. And like you were saying earlier on, I'm independent. If you don't like that, then we'll have a chat about it. But
I think it's just business. I remember having this conversation with fees with Ray Dolben, who's a lawyer. You know him, Ray Dale. And he says because we was having a conversation, I was like, do you get paid on completion, Ray? I know Ray's top stance on this before. And he goes, no, early days, yes, you could pay me on completion when I was a fool. But then a lot of lawyers will go 50% up front, 50% on completion. He goes, you will pay me 25% at instruction, 25% on completion, and then there's 2 other milestone payments that he takes. So he divvies it up. So he goes, that helps my cash flow.
Yeah, so milestone, I work on milestones as well, where you just have a small fee on commencement, small fee on indicative terms.
Yeah.
And then sometimes, depending on what it's like, sometimes you do a small fee on offer sometimes, and then at completion. That offer one, for something like an asset-based lend, that doesn't make any sense, because as soon as the offer's there, that's it complete. So yeah, it's just sort of trying to work out a structure that fits for the client and actually doesn't leave me running around doing all sorts of work.
I think
to never deliver anything.
with you and a client doing the whole up to 12 weeks, it makes them hurry up for a start, and it makes them more tuned in to obviously their acquisition, their target, and to work alongside you. But 9 times out of 10, when they're getting you probably onboarding you, they should be fine-tuned anyway, you know, and getting geared up or close to heads, if not there. Because ideally you want to be instructed before heads of terms, but 9 times out of 10, I'm guessing they come to you once they've signed them.
Well, so that's sometimes frustrating, because you sort of look at it and think that's a great opportunity, it's a brilliant deal you've got in terms of the headline price. However, the structure you've got in your head is completely unfundable. But if I'm just having a conversation with someone before they've got to heads, often I'll just say, look, I'll just do that. That's fine. But and you do get a sense for some people that it's the people. I've had bitter experience over the last sort of 12 months, and you just end up wasting an awful lot of your time for people who, to be honest, have never had any intention of paying.
I get exactly where you're coming from, but like with me, when I've done transactions, like my legals and my due diligence, because I understand the risk I'm taking is always higher than most because of the industry I operate in. I approached them with like, it's just a tick box exercise. Like, I knew that my lawyer, I could probably get a cheap one, because I know that if it goes down the drain, it's just going down the drain. I'm not claiming on anything. Financial due diligence, my first 2, I done it myself stupidly. For the others, I've paid people to do that, but it's not been a massive in-depth thing, because I still know that I'm buying a risk. I'm getting skeletons post day 2, 3. They're all coming out, because you don't get to talk to like in-house. But people,
but on both sides, those due diligence, like you look at the engagement letter they'll give you to sign. I don't think it will ever say we guarantee we'll find everything.
No. And it never should do either.
So they're full of like caveats, and so you've got a bit more cover, but it's not 100%.
No,
it's like any insurance policy.
But if you want to go down the rabbit hole of protecting yourself before an acquisition, I mean, you can spend like 30, 40 grand, and then the seller will go, no, I don't want to do it, and pull it. You're left for that bill, you know. So there's that as well. You got to be able to fund, and that's why people are going, it's a no money down deal. What are your legal fees before completion costing you? Because that's a fee. Don't get me wrong, you might be able to do something creative and get the business to pay for them fees after completion, but it's not a no money down deal, because you're having to front that money.
If I always say to people,
I hate that term. But that's just me.
I know probably about 200 lenders, maybe more. Some of them are specifically in a particular area. But so given that, if you could buy a good quality business for nothing, how many businesses do you think I'd own? If I didn't have to commit anything myself. Would there be no end to the number of businesses?
That's it,
Just trust me. It's not. You don't get anything. My dad's old saying: you don't get anything in life that's worth having for free.
No, that's it. And that's why, like, people who do the whole distressed acquisition sort of model, or people who I know, like serial entrepreneurs who have tried to distress £1 buy, it's killed them. Every single one, they've gone in, no, I'm never doing it again, or majority of them have gone, it's made me so sick. It's like Charlie Norton, his story, and he'd done this £1 buy. After 9 months, he put himself in hospital where he's so stressed. You know what I mean? He just give it back to him. You have it for £1 back. I think that was the story. You know,
it's that's where I cut my teeth, was in restructuring. And so it's you got to be. I loved it because I wasn't the person buying the businesses, but I was often the person selling them actually. But it's the purest commerciality. The whole thing around an insolvency. So the day you get appointed as administrator, actually from the time you're on the hook, and there's no cash you can use. That's all subject to the insolvency proceeding. So somehow you've got to run a business where you've walked in, and at the moment we have no cash.
Yeah, it's an
and
art form in itself.
Yeah.
Yeah.
And that's the thing, is you can buy the business for £1. You're going to have to pump money into it to get it through the first month end.
Yeah, definitely. Yeah, not one for me. I had another guy that I know. He's getting into acquisitions. I can't call him my mentee because he's not. He won't have me. He's too serious. Bless him. He's really focused. He goes, yeah, I've been reading this book on insolvent businesses, distressed businesses. I went, no. He goes, what? I went, no. I went, you haven't made one business acquisition yet. Do not think you can go in that. I said, if you want to go down the route of distressed businesses, go and work for an insolvency practitioner.
Yeah.
Go and do that for 2 years and then do it that. Then learn underneath them and go through that way. That's cool. That's fine. Do not. He goes, yeah, but the uplift. I went, figures, stories, it looks sexy. In reality, you will blow a gasket, especially for your first acquisition. So I said, don't do that. He goes, yeah, thanks. But they are not for the faint-hearted. He goes, what do you do? I went, I've been doing acquisitions for 5-6 years, and I work day to day in the industry. I would still not approach a business and say, I'm going to do this. I can do it. I can take it from insolvency to take it from the red to the black. I wouldn't do that.
Yeah.
Personally. I still don't have that skill set. I know that, but I can hold my hands up. I'm not there yet, and I've had many businesses, but I don't reckon I could handle that.
Yeah, I've had a few clients.
It's got to have an art form to it.
Yeah, and pretty brutal. So I had a client a few years back, and his model, he got disqualified as a director, not for anything in particular, but a pattern of behaviour.
Yeah,
and it was an odd disqualification.
Probably just misreporting or something.
No, it was only 18 months. No, what it was his thing was back in the sort of late 90s into the 2000s. He was into the 2010s. He was buying companies where you had, remember the furore around final salary pensions and putting the liability on your balance sheet and all that sort of thing. Busting. So companies becoming insolvent.
Yeah.
And he was buying those where there was a significant property asset. And then the blunt tool you use to restructure stuff, you then put those into administration. So you take the company, you bust it yourself and come out the other side. So you pull the asset out, leave the pension back in the insolvent business. And he did that a number of times. Some quite
just a bit crafty though, isn't it?
Some quite
clever but crafty.
Yeah, he's if you brought him around to the house, he'd check the silver afterwards. And he ended up, as I say, getting the disqualification in the end, just because he wasn't doing anything that.
It's just immoral, though, isn't it?
It just didn't contravene any of the regulation. It just didn't feel right.
Yeah.
So there are ways around it, but you've got to be pretty ruthless. You're treading quite a fine line.
Yeah.
Yeah, because when a business is insolvent, suddenly it opens up the risks of personal insolvency.
Yeah. Going back to Goldfinch, what are you trying to do with Goldfinch for this coming year? What's on the horizon?
Get a couple of chunky transactions over the line.
Yeah, nice.
Then go to a beach. But I just continue to build a book of clients, really.
Yeah, nice.
I mean, ideally some nice, really simple, people who just want to refinance a bit of kit, or done a piece of work with someone recently where eventually managed to get them to understand that keep on going to the brokers they've been using before to buy 10 commercial vehicles at a time, but they're spending $1 million a year on vehicles.
Yeah.
Why don't you just get, when you've got $6 million of finance, why don't you just get a big revolving facility secured on all those vehicles, and
buy it?
Actually your monthly servicing cost drops through the floor, and you generate so much free cash that you can build a new fleet that isn't subject to any finance. So stuff like that is always interesting. And then sort of M&A it is intriguing. It's challenging at the moment for all the reasons we've discussed.
Yeah, we were saying off camera, it's just very cautious. For the last 6 months, it's been super cautious. I thought it was getting better towards the mid from Q3, Q4 last year, but it's sort of not flatlined, but it's gone a bit.
Yeah,
everyone's you get the serial guys who just doesn't matter. They got their capital, they're going. But in the market that I deal with, like sub 20 million SME, it's you can't get anyone to convert at the minute.
And you look at some of the actions of lenders to lenders at the moment. So a lot of the banks are typically funded to a large extent on customer deposits. So they also take money out of the wholesale market. But then you've got the non-bank lenders who are effectively asset managers, and the funds come from pension funds off the wholesale market from the bigger lenders themselves. And what you're seeing there is the rates they're being charged going up because the lenders that are lending to them are saying, looking through at your portfolio, oil and gas prices going through the roof, all this global uncertainty.
It's just an excuse to risk there.
Yeah, it's just risk. So it is going to be a challenging time, and I think that takes you round to, increasingly just sometimes with clients is just talking to them about, it's that soft touch stuff. So yes, you could go to that lender, but they're a straight lender. They're using other people's funds. So if things get difficult for your business, they will cut you off at the knees. And the bit that people need to understand, particularly with secured lenders, is they don't wait until they're unsecured to enforce. But why would you do that? So, because you always get the argument, people saying, I don't understand why they're getting so difficult because they're fully secured. Exactly, that's why they're difficult.
Yeah.
It's so I think there's some challenging times, but hopefully it's just continue to build that book and want or need to take on too many clients at a time because we're a very small business, and it's all based around personal contacts. It's effectively you buying into me and my Lord knows how many years of trudging.
No, look, I'm always like my stance. I always like to recommend the small independent over the corp, but that's just me because that's just what I do. But no, thank you very much for coming, mate. It's been a pleasure. Thank you.
Thanks very much.
Cheers, boy.
Take care.